There's a sentence in Market Wizards that has bothered traders for 40 years. It was said by a man whose track record makes almost every fund manager alive look ordinary, and it goes like this. Everybody gets what they want out of the market. Read that again, slowly, because on the surface it sounds absurd. You don't want to lose. Nobody wants to lose. You've stayed up studying charts. You've felt sick watching your account bleed. You've promised yourself it would be different this time. How can anyone say you're getting what you want? But Ed Seykota wasn't being cruel when he said it. He was being precise. And if you can sit with this idea for the next half hour without flinching away from it, it may explain more about your trading than every strategy video you've ever watched. Because if it's true, even partly true, then the thing standing between you and profitability isn't out there in the market. It's a want you haven't looked at yet. First, understand who said it, because it matters. Ed Seykota was one of the earliest traders to computerize trend following, back when that meant punch cards and mainframes. His results were the kind that get double-checked. One client account under his management grew by a figure so large that when people quote it, they add a disclaimer. When Jack Schwager asked other market wizards who the best trader they knew was, Seykota's name kept coming up. This wasn't a motivational speaker. This was a quiet, systematic man who let computers tell him when the trend had turned, and who spent decades studying the one variable his systems couldn't automate, the human being pressing the buttons. And that's what makes his sentence dangerous. It didn't come from someone who failed and rationalized it. It came from someone who won repeatedly for decades, and then looked around at everyone losing and noticed something the losers couldn't see about themselves. And there's a detail about Seykota that makes his claim land harder. He wasn't primarily a discretionary trader reading his gut. He built mechanical systems, tested them, and then followed them, which means he had removed, deliberately, almost every opportunity for emotion to touch a decision. Entry, computed. Exit, computed. Size, computed. And after all that engineering, after taking the human out of the loop as thoroughly as anyone in that era could, what did he conclude was the deciding variable? The human. He wrote that the elements of good trading are cutting losses, and cutting losses. Not finding trades. Cutting losses 3 times, as if repetition would make it stick. He said if you can't take a small loss, sooner or later you'll take the mother of all losses. He said there are old traders and there are bold traders, but very few old, bold traders. Look at what all of those have in common. Not one of them is about prediction. Every single one is about what a person is willing to feel. Seykota built machines and then spent his life studying the operator, because the operator was the only remaining point of failure. That's the man who told you you're getting what you want. So what did he actually mean? Not that you consciously want to lose money. Nobody wakes up hoping to blow an account. He meant something more uncomfortable. That beneath the want you can name, there are wants you can't. And those hidden wants are running your hands. Think about what a losing trade actually delivers. It delivers a story. It delivers a jolt of adrenaline. It delivers relief from boredom. Sometimes it delivers proof of something you already believed about yourself. Every one of those is a payoff. And the human nervous system will chase a payoff it can feel right now over a payoff it has been promised for later every single time, no matter what your trading plan says on paper. Mark Douglas spent his career on this exact point. He argued that traders don't trade markets. They trade their beliefs about markets, and that most of the beliefs doing the damage were never consciously chosen or examined. Seykota's sentence is the same insight, delivered with less mercy. You're getting something. The question is what? So let's set the myth on fire, because it's the most comforting lie in trading. The myth says, I already know what I want. I want to be profitable. Therefore, the only thing missing is information. And that myth is why so many traders spend years collecting strategies like stamps. New indicator, new system, new course, another backtest. If information were the missing piece, the internet would have produced millions of profitable traders by now. It hasn't. What it has produced is millions of extremely well-informed people who still can't follow their own rules. Here's the thing information cannot do. It cannot want for you. It cannot make the boring correct action feel better than the exciting wrong one. That's why the trader with 3 indicators beats the trader with 30. He isn't smarter. He's just wanting the right thing. By the end of this video, you'll know the 4 hidden wants that hijack traders, which one is running you, and how the wizards rewired theirs. And I promise you this, the ending is hopeful because a want is not a life sentence. It's a habit with a payoff, and payoffs can be redesigned. Now, I can hear the objection because I've made it myself. You're thinking, this is nonsense, I genuinely want to win. I've wanted it desperately for years, I've sacrificed for it. And I believe you, completely. So let me sharpen the claim, because Seykota isn't saying your conscious one is fake. He's saying it isn't the only one in the room, and it isn't the one with its hands on the mouse at the worst moments. Consider anyone who has ever tried to change a habit. Someone genuinely wants to be healthy and genuinely eats the thing at 11 at night. Both wants are real. One is louder in daylight, and one is louder in the dark. Trading just compresses that conflict into seconds and attaches money to it. The proof isn't in what you feel while watching a video like this one, calm and reflective and fully agreeing with me. The proof is in what you did the last time price ran against you and your chest tightened. That version of you, the one under pressure, is the one placing the orders. And he wants something. This whole video is an attempt to introduce you to him because you cannot negotiate with someone you've never met. The first hidden want is the easiest to spot in others and the hardest to admit in yourself. Excitement. Ask an honest question. When a market is quiet, when your setup isn't there, when the correct action is to do absolutely nothing for 3 days, how does that feel? If the honest answer is restless, itchy, almost unbearable, then part of you didn't come here for money. Part of you came here for aliveness. And the market is the most efficient aliveness dispenser ever invented. It's open, it's liquid, it moves, and it will let you feel something enormous within seconds of clicking a button. No casino, no video game, no sport gives you that with your own real money on the line at 3 in the morning. Michael Marcus, in his own interview, described his early trading as being driven by exactly this. He was chasing something and noticed that excitement has a signature you can detect. The trades you take when you're bored are almost never your best setups. They're the marginal ones, the almost setups, the ones you talk yourself into. Your system didn't fire. Your want did. Here's why this want destroys accounts specifically. A trading edge is, by design, boring. It has to be. An edge only works if it's repeated identically across a large sample, which means the correct experience of a working system is monotony punctuated by occasional short bursts. That's it. That's the whole job. So a trader who needs excitement is in permanent, structural conflict with his own strategy. Every day the system is doing its job correctly is a day he feels dead inside. And eventually, inevitably, he does something to feel alive, sizes up, takes a marginal setup, moves a stop to give it room. Not because he analyzed anything, because he needed a heartbeat. And here's the brutal accounting. He gets exactly what he wanted. He got excitement. It cost him $4,000, but the transaction was completed. The market delivered his order. He just placed it with a part of himself he wasn't listening to. Want a way to test whether excitement is your driver? Look at your own history rather than your intentions. Pull up your last 30 trades and mark each one. Was this a setup my rules define? Yes or no? Then look only at the no's. Ask when they happened. Almost universally, 3 patterns show up. They cluster after a period of no action, which is boredom. They cluster right after a loss, which is the urge to feel back in the game. And they cluster after a win, which is the appetite that success switches on. Notice what's absent from all 3. Any relationship to what the market was actually doing. The market didn't call you. Your state did. And here's the diagnostic that settles it. Imagine your system produced identical annual returns, but only fired 4 times a year, with total silence in between. If your honest reaction to that is relief, excitement isn't your want. If your honest reaction is that sounds unbearable, you have your answer, and you now know something about yourself worth more than any indicator you'll ever buy. The second want you already met in the story of Marty Schwartz, but let's go deeper because it wears a very convincing disguise. It disguises itself as diligence. The want to be right looks like doing more research, waiting for one more confirmation, defending a position, arguing with the tape. It feels responsible. It feels like the opposite of gambling. But watch what it actually produces. It produces traders who hold losers because exiting is an admission. It produces traders who cut winners early because a small locked-in profit is proof they were right, while a large open profit is still a chance to be proven wrong. It produces traders who can tell you exactly why the market is behaving irrationally while their account shrinks. Douglas identified this as one of the primary fears, the fear of being wrong. And he made a point I want you to hold on to. The market cannot make you wrong. Only your definition of wrong can do that. If wrong means my analysis didn't play out, that's information. It costs you one small plan loss and you move on. If wrong means I'm not as smart as I need to be, you'll pay any amount of money to avoid it. Same trade, same tick, completely different bill. And now apply Seykota's lens to it, because this is where it gets uncomfortable. The trader who holds a loser for 3 weeks, refusing to exit, watching it get worse, is not failing to get what he wants. He is succeeding. What he wants is to not be wrong. And as long as the position is open, he isn't wrong yet. He's just early. Do you see the trap? The open position is a machine for postponing a verdict. It delivers exactly the thing he wants, which is the absence of a final answer, and it charges him for the service by the day. The moment he closes it, the want is denied and the pain arrives all at once. So he doesn't close it. He gets what he wants. He goes broke getting it. This is the most expensive want in trading and the hardest to see because unlike excitement, it never looks reckless. It looks like conviction. It looks like patience. It even quotes the wizards back at you. Didn't they say ride your winners? Yes, ride winners. Nobody ever said ride losers. Those are opposite behaviors that feel identical from the inside when you need to be right. And this isn't one man's theory. Larry Haight, in his own Market Wizards interview, described knowing a trader who had been in the business for years and who, in Haight's assessment, simply did not want to make money. Not as an insult, as an observation about behavior that no other explanation fit. Read enough of those interviews and you start noticing how often the wizards talk about other people's psychology rather than other people's analysis. They aren't puzzled by why most traders can't read a chart. They're struck by how many can read one perfectly and still can't act on it. That gap between knowing and doing is the entire subject of this video, and it is the only gap that has ever mattered. Because the market pays for behavior, not for understanding. It has never once written a check for an accurate opinion, which is why a trader with a mediocre system and clean execution reliably beats a trader with a brilliant system and a hidden want, and why that outcome feels so deeply unfair to everyone it happens to. The third want is the darkest, and I want to handle it carefully because for some of you, this is going to land hard. Some traders want to be punished. Seykota said it plainly. Some people seem to like to lose, so they win by losing. That sounds insane until you've watched it happen. A trader has a great month, his best ever, and then does something so uncharacteristically reckless that he gives it all back within days. Ask him why, and he genuinely cannot tell you. He'll say, I don't know what came over me. Here's one explanation that fits. On some level, he didn't believe he was allowed to keep it. Money is not neutral for human beings. It's tangled up with worth, with family stories, with old ideas about who deserves what. If some part of you carries a belief that you don't deserve to win, that people like you don't make it, that success is for other people, then a growing account creates unbearable internal tension. And the fastest way to relieve that tension is to give the money back, which he does, efficiently, and feels, strangely, calmer afterward. That calm is the tell. That's the payoff being collected. If any part of that made your stomach drop, I want to say something directly to you. That is not a character defect, and it is not permanent. It's a belief you absorbed, probably early, probably without consent, and beliefs are learnable and therefore unlearnable. Douglas's entire body of work rests on the claim that beliefs, not talent, determine trading outcomes, and that beliefs can be deliberately restructured. Seykota, notably, spent much of his later life on exactly this. He ran a group called the Trading Tribe, focused on processing the feelings that drive trading behavior, precisely because he believed the emotional layer was the real trading system underneath the technical one. The greatest trend follower of his generation concluded that the work was psychological. That should tell you where the leverage is. And notice the hope hiding in this want, the one nobody points out. If you can sabotage yourself with that much precision and consistency, you are not undisciplined. You are extremely disciplined. You're just executing a plan you never consciously wrote. Discipline was never your problem. Direction was. The fourth one is the most modern, and it barely existed when Seykota gave that interview. Some traders want a story, not money. A story. They want to be the person who called it. The one who was an early, who took the big swing, who has a screenshot. And this one has been industrialized. The entire social ecosystem around trading now pays out in likes and clout for exactly the behavior that destroys accounts. Nobody screenshots a 1% risk position sized properly and exited a plan. Nobody goes viral for sitting in cash for 6 days waiting for a setup. The stories that travel are the enormous wins and the spectacular disasters, which means the reward system you're swimming in is precisely inverted from the reward system that produces wealth. So a trader optimizes unconsciously for the story. He takes the trade that would be a great story. He sizes for the screenshot. He gets what he wants. He becomes a character in an interesting narrative. It's just an expensive genre. And the wizards, almost to a man, are the opposite of this. Read their interviews and notice how boring they sound. Cut losses. Small size. Follow the plan. Wait. Nobody would clip it. And they all got rich. So why can't you simply decide to stop? You know all of this now. Why won't knowing be enough? Because a want operates on a completely different timescale than a plan. Your plan pays out later, in probability, across a sample you can't feel. Your want pays out now, in sensation guaranteed. And the human nervous system was built long before markets existed, in an environment where now always beat later. This is why willpower fails so reliably in trading, and why every trader who has promised himself will be disciplined starting Monday knows exactly how that ends. You cannot out-willpower a payoff. You can only replace it. Douglas said something similar in different language. He argued you can't force yourself to follow rules you don't believe in at the deepest level, because in the moment of pressure, belief wins and rules evaporate. Which means the real work isn't building more discipline on top of a want that's fighting you. It's going down a level and changing what pays you. That's the whole game. And it's the part almost nobody does, which is precisely why so few make it. Not because it's hard to understand, because it's uncomfortable to look at. I want to be careful here, because this idea has a cheap cousin and I don't want you confusing them. The cheap version says, think positive, visualize profits, believe in abundance, and the market will reward you. That's not this. The market does not respond to your beliefs. It has no idea you exist, and no amount of wanting will make a losing strategy profitable. What we're describing is far more ordinary and far more useful. Your beliefs and wants don't influence the market. They influence you. They determine which trades you take, how big, how long you hold, and whether you can execute your own plan under pressure. The market stays indifferent, and your behavior does all the moving. That's why this is testable rather than mystical. Change what pays you internally, and your execution changes, and your execution is the only thing you ever actually controlled. Douglas made this distinction constantly, insisting that consistency comes from the trader's mental framework rather than from anything the market provides. So this is not manifestation. It's maintenance on the only machine you own. Now here's where Seykota's sentence flips from cruel to liberating. And this is the heart of this video. If you get what you want out of the market, then you're not a victim of the market. You've been steering the whole time. That's terrible news for your excuses and extraordinary news for your future, because it means the lever was never the economy, the algorithms, the market makers, the news, or your broker. The lever is what you want, and wants can be changed, not by force, by design. Every trader who turned it around did the same fundamental thing. They found something more satisfying to want than the thing that was costing them. Schwartz stopped wanting to be right and started wanting to be rich, and his skill came online overnight. Marcus stopped wanting the thrill and started wanting survival, and the fortune followed. Jones stopped wanting to win and started wanting to defend, and became a legend. Seykota wanted his system followed, so a loss was a system working, not a wound. In every case, the strategy was already there. What changed was the payoff they were reaching for. So let's make this practical. 5 practices. 1. Run the payoff audit. After every trade that broke your rules, and only those, write one line. What did I actually get? Now what did I lose? What did I receive? Excitement. Relief. A story. The feeling of being right. Escape from boredom. Proof of something old. Be blunt. Nobody's reading it. Do this for 20 broken rules, and a pattern will appear, so clearly you'll wonder how you missed it. That pattern is your want, and naming it is more than half the work, because a want operating in daylight loses most of its power. 2. Build a legitimate outlet for what you actually crave. If the audit says excitement, you don't fix that by declaring you'll never seek excitement again. That's the willpower trap. You fix it by giving the want a sandbox where it can't hurt you. Some traders keep a tiny separate account, an amount they genuinely shrug at losing, explicitly labeled the entertainment account. That's where the itch gets scratched. The real account stays boring because it now has a job it isn't in conflict with. If the audit says story, then post your process, not your P&L. Build an identity around discipline rather than around calls. The want gets fed. Your capital doesn't pay for it. 3. Make the boring thing pay you immediately. This is the highest leverage practice in this video. Right now, your process pays out in months, and your impulses pay out in seconds, which is a fight the process cannot win. So install a same-day payoff for correct behavior. Grade every session on execution only 0 to 10 and log it. Track a streak of rule-following days the way you'd track anything you're trying to build, and refuse to break the chain. It sounds almost childish. It works because it's the only thing that competes on the time scale where the damage actually happens. You're not trying to feel nothing. You're trying to make the right action feel like something. 4. Use the resistance as your instrument. Here's Seykota's most practical idea reframed. The elements of good trading are cutting losses, and cutting losses. Simple to say. Now notice what happens in your body when you go to do it. That flinch, that stall, that reflex to check one more chart before clicking, that's not weakness. That's your hidden one objecting out loud. It is the single most useful signal you will ever get because it's real time. Most traders discover their psychology in a journal weeks later. You can catch at the exact millisecond it's steering. So when you feel the resistance, say quietly, "There it is." Then take the loss anyway. Every repetition of feeling the want and acting against it weakens it, and every surrender strengthens it. That's the whole mechanism of change, and there is no other one. 5. Define what winning would even look like in writing before you need it. Most traders have never actually specified this. They say they want to make money, which is not a target, it's a direction. What amount, over what period, at what risk, at what cost to the rest of your life? A vague one gets hijacked by whatever one is loudest today. A specific one gives you something to defend. Write the sentence. I am trading to achieve this, and I am willing to be bored, wrong, and patient to get it. If you can't finish that sentence honestly, that's not a failure. That's the most valuable information in this video, because it means you haven't yet decided what you're here for, and the market will happily decide for you. A word about how long this takes, because false timelines break more traders than false systems. Changing a want isn't a weekend project, and it isn't a decade either. What actually happens looks like this. First, you notice the want after the damage in the journal. Days later, and it feels useless. It isn't. That's stage 1, and everyone starts there. Then you start noticing it during the mistake, mid-click, which is maddening because you can see yourself doing it and do it anyway. Then, eventually, you notice it just before in the flinch, in the tightening, and for the first time you get a genuine choice. And the choice will feel unimpressive when it arrives. It won't feel like triumph. It'll feel like a small, boring, slightly disappointing act of not doing the thing. That's what progress feels like from the inside, and it's why so many people miss it and quit right before it compounds. Expect regressions too, especially after your best weeks, because success stirs up every old belief about what you deserve. That's not failure. That's the old want making its argument. You're allowed to hear it and still not obey it. Let's stand back. Everybody gets what they want out of the market. Not because the market is fair, but because your behavior is faithful to the payoff you're actually chasing rather than the one you talk about. For wants do most of the damage. Excitement, which puts you at war with the boredom your edge requires. Being right, which turns every open position into a machine for postponing a verdict at daily cost. Punishment, which quietly hands the money back when you exceed what some old belief says you deserve. And the story, which makes you optimize for a screenshot in a system that pays out in decades. Underneath all 4 is the same mechanism Douglas spent his life describing. Beliefs and payoffs operating below the level you can argue with, deciding your hands before your plan gets a vote. But here's what I want you to leave with, and I mean this as the most hopeful thing I know about this profession. If you're getting what you want, then you have been in control the entire time. You were never the victim of the market. You were being served by it precisely according to an order you didn't know you'd placed. And that means the change you've been trying to force from the outside, with more indicators, more screen time, more promises, was always available on the inside at the level of what pays you. You don't need to become a different person. You need to want a different thing, and then feed that one until it's louder than the old one. That's not mysticism. It's the same work Marcus did, and Schwartz, and Jones, and Seykota himself. So here's my question for the comments. And be honest, because your honesty gives someone else permission. Which one is running you? Excitement, being right, punishment, or the story? Just name it. One word is enough. Naming it in public is how it starts losing its grip. And if this video showed you something about yourself you hadn't seen, share it with one trader you know. Not for me, because somebody out there is about to place an order for excitement with money they can't afford, and this might reach them first. Subscribe if you want to keep going, because we're only beginning to map how this works. Next time, why support and resistance aren't lines on a chart at all, but the exact places where human regret is stored, and how the wizards read other people's pain to find their entries. Until then, remember, you are getting what you want. So want something worth getting. I'll see you in the next one.